Welcome to the New York City Employees Retirement System Investment Meeting. Today is June 25th, and we are at 335 Adams Street in Brooklyn. And Diane, would you please call the roll?
Here.
Here.
Controller's Office.
Here.
Public Advocate's Office.
Here.
Borough President Manhattan. Borough President Brooklyn. Borough President Queens.
Here.
Borough President Staten Island. Borough President Bronx.
Here.
International Brotherhood of Teamsters.
Here.
Transport Workers Union.
Here.
District Council 37.
Here.
We have a quorum.
Thank you. And before we get started, do we have any changes or additions to the agenda today?
Yes, I would have to hit. Oh no, sorry.
Okay. I think we have one addition to the agenda. The committee, I'm not sure what the committee is actually called, but the emerging markets.
The intrepid.
We're going to add an agenda item to the executive session for a committee report. Okay. And yes?
Janice, if it's possible, I just wanted to give like just a 2-minute account. I attended on behalf of NYCERS the private equity conference in London on the 13th, and just wanted to, if it please the board, just to relate what took place.
Would you like to do that now? Or?
Sure.
Sure.
Glad
Okay.
to.
Please. No one objects.
Well, June 13th, there was an organization called Private Equity International, and they sponsor events. And UNPRI, Principles for Responsible Investment, to which NYCERS is a signatory, sponsored a one-day conference in London to examine to ESG matters as pertains to private equity from a manner of different perspectives. And there were different panels, and I was invited to be a panelist, sort of to give the labor perspective, trustee perspective on issues of ESG. So we had, I would say, a spirited discussion and goals, and so, and I was on a panel with panelists from Europe representing various private equity firms. What I thought was most interesting about the day and the panel of people that I met is it seems to me that in Europe, the funds that were there, that ESG matters seem to be much more closely integrated into the work of these firms. And of course, I don't have the experience of, I have not worked in a private equity firm in the United States, but it seems to be more taken for granted in the way that people spoke, that basically that this is just a part of the DNA. So my comments to that was that at NYCERS we're moving in that direction, but it's a process, and it requires resources and dedicated resources, and we're not quite there yet, but it is a process. But the board is very interested and concerned about those issues, so we see a certain amount of progress that's been made on our end, and a lot of progress that can be made going forward.
Well, thanks, and thanks for sharing the European perspective as well.
Thank you.
All right. And just to note for the record that, yes.
Sorry for my
It's okay.
tardiness.
I didn't miss anything.
And Larry, I
Okay.
guess we'll hand it over to you.
So before we go through the March numbers and then the April numbers, all of which are now historic and somewhat irrelevant, I thought I would answer the simple question of what's going on. And again, we'll go through the March numbers, we'll go through the April numbers. It's good that we have a nice running start in the fiscal year, because the fiscal year is kind of blown apart in the month of June. So here's the question of what's going on, and how we position for what is going on. So as we all know, the Fed has done QE1, QE2, QE3, as have a variety of other monetary authorities throughout the world, and they've sort of flooded the world with cash. And the reason they flood the world with cash is because we had this market implosion in '08 and '09, and the only way to deal with it was to keep rates low as long as possible, which they've done. And as you all know, the Fed has two mandates. One is to keep inflation down to a manageable level, which they say is about 2%, and to work toward accommodating something approaching full employment. But again, the monetary policy is one of two big weapons. The other weapon is fiscal policy. Fiscal policy is controlled by the government in Washington. The government in Washington has seemed to be stuck with different ideologies, so fiscal policy really hasn't come to bear. So it's all been on the Fed, which I think has done just a great job, by the way. And over the last 4 years, the Fed's bought now $3.4 trillion of government securities and mortgages, and at some point has to stop buying them, and at some point has to sort of point the ship a little more toward normalcy. And if you recall, probably last year, they said, hey, we're going to keep rates down, and they put a date on it. And the date was June 2015 because they wanted you to realize it's a long time. We're not going to mess with the interest rates for a long, long time. So please start taking risk, because we're not going to have markets that pay you to sit around and absorb the risk-free rate. So we're going to keep rates as low as possible until, again, pick a date, June 2015. And they've shifted that about 6 or 9 months ago and said, oh, you know what? A date is sort of confining because it's a point in time. We'll tell you what our goal is. Our goal is 6.5% unemployment. And as we start approaching that, or we get to it, we're going to start easing up on the monetary policy so that, again, rates can go back up and things will be fine. Our definition of fine is about 6.5% unemployment. And we all know we have all these charts in here that says, hey, you know, we're kind of getting there. It was 9 and 10, and now it's 7.6%. So if you look on the charts in here, I think it's page 5, it's slowly trending down, and people can argue about when you get there, when you don't get there. But again, they're trying to be open and transparent and talk about it. Because there have been, as we've all witnessed, there have been some peculiar things that happen when you as the government say we're going to keep rates low, you get bubbles. So you get the high yield market, which is pretty frothy, frothy as most people can remember. But it has done exactly what they wanted to do, which is if you're not going to make a lot of money in government, you have to go where the yield is, which is high yield, so you go too far to high yield, and ultimately you put the money in the stock market. So the stock market's had a wonderful ride for the last, well, it's up 50% from the bottom, but it's had a wonderful ride, particularly the last 12 months. And we've profited from that, right? So we're set up the way we're supposed to be set up. We're long U.S. equities, we're long high-yield bonds, we're short governments, and we're short tips, all of which has done well. In fact, you know, we've made 14% year-to-date, and we'll spend some time on the details of how that works. That said, that was all well and good, but you knew it kind of had to stop at some point. And the Fed's job now is trying to signal that they'd like to stop, but they're not really stopping. We're not going to actually tell you when we're going to stop, but we might decide that now is a good time to think about stopping. If that sounds a little mumbly, that's kind of Fed speak. We can't tell you exactly, but we can tell you that we're now thinking about stopping in a manner by which you can say, well, yes, we're making progress, but no, we're not going to tell you exactly when. So the Fed tried explaining that a month or two ago, and it wasn't explained to the market's satisfaction. And the market is a little bit like an addict. They really, really have leaned into this easy money, right? That's how you get this bubble in the high yield market, where the high yield rates are below 6%, which is not high. It's only high relative to zero. It's not high relative to normal times. So they had a meeting, I guess it was last week. Fed 2-day offsite. Fed has a press release, and Bernanke has some questions and answers, and this time they said, all right, we're going to try to explain this better than we did a month ago because things didn't quite work. So I'm not going to get into what he said or what he didn't say, but the reaction was, I would tell you, not quite as planned, because the markets are not quite, we can't plan global markets. So the rates instantly shot up. Again, their job is not to manipulate markets, not to, on a day-to-day basis. They really don't care what happens on a day-to-day basis, but their goal is to slowly tell you that we're going to bring rates up when we, the Fed, think it's right. And it was interpreted as sooner than most people thought. So sooner than most people thought means get out of the way. So get out of the way means interest rates like that.
But Larry, didn't he also put in a disclaimer and said something, if it's not appropriate, it wouldn't happen?
Yeah, he's trying to say exactly what you'd like him to say, which is, I got it, we're doing a good job, we can't keep doing this indefinitely, and again, our goal is to get unemployment down to 6.5%. We can lower things, we can stop purchasing bonds, we can lower our purchase, we can also increase our purchase. We're not going to let things get out of control. What we're trying to tell you is we're not going to let things get out of control. We spent $3.4 trillion getting to where we are. If we have to spend more money, we will. But we think we've shocked the patients enough and the numbers are all starting to look trending up. So if they're trending up and we think they're going to get there, we just want you guys to know it's what we're going to ease off this thing a little bit. How you say that and what people hear versus what you say are completely different. So he said whatever he said. 2-3 days later, the markets are in complete disarray. People who were at the meetings don't vote. Other Fed presidents start saying, what he meant to say was this, you're not listening to us. So now you have an awful lot of chatter going on. It doesn't really matter what he meant to say. What he's trying to say is exactly what you point out, which is, all right, I'm slowly going to take my foot off the pedal, but we're going to do this in an organized, controlled way, as organized, as controlled as we, the Fed, can be. But it is the world's largest market, the bond market. So it doesn't go in a straight line. So the market has sort of reacted quite violently. I won't say it's overreacted. Who knows? It's the market. And the consequence of that is a lot of people have made a lot of investments on the theory that it was going to last a little longer than perhaps he said. Gee, if it's going to last a little longer, now he's shortened it, means I should get out. So what started as a little trickle getting out has sort of become a stampede getting out. And when you thought, gee, if it was 1.6% the 10-year, you probably couldn't imagine it going to 2.6% in 2 months. That's just a lot. But it's happened, and markets have backed up. And as you may recall from as long as you've been on this board, for those who've been over here a while, things can get out of control, and they get out of control, and they get back under control. So we're a little bit in one of those somewhat uncontrolled phases, all of which, in the long run, make a lot of sense, right? You can't keep interest rates this low forever, so it's not surprising he wants to lighten it up a little. Having said that, he's pretty adamant. He said, look, we're not raising rates until 2015, so everybody relax. We're just going to, at some point, not today, stop buying $85 billion of bonds a month. Overreaction, who knows? The market is all-knowing. Makes no sense on certain days, knows a lot on certain other days. That being said, it is the 12th month of a 12-month fiscal year. So I would tell you, it couldn't have come at a worse time for us, right? It's like, gee whiz, we're trying to make some plans. But again, the good news was we came into it set right. We were up 14% coming into June. We've given back some of it. I'll walk you through those numbers. And life will go on past June 30, and we'll just kind of keep playing through July and August and September. And ultimately, things will calm down. The good news is, and I would say thanks to the Fed, the economy has healed. It hasn't healed as fast as we would like. We were a little frustrated how slow it is, but the economy's healed. All the charts in here trend upward. There's lots of uncertainty out there. It's unfortunate it happens to be June, but again, we're going to walk you through this. I don't think it's anything to panic about. We're not panicked about it. Our managers aren't panicked about it. The severity is much worse than anyone thought, but it's a little bit like a fever. It'll pass. So I just want everyone to understand we're actually positioned correctly for exactly what's going on. You could tweak it a little here, a little tweak it there, but again, this is a tanker. You don't just turn it left and turn it right. So our crystal ball's a little cloudier than usual, but again, if there was anyone to bet on, it was probably Ben Bernanke and the Fed, because it's worked pretty damn well so far. So communications is a complicated thing. We'll have a bumpy rest of the week. I think it'll go up a little bit between now and then, and we'll see. So I wanted to just let you know that we're all over it. What you read in the papers is whatever the papers want to report on. It is more volatile. We're set up right for the volatility. We'll walk you through the numbers, but again, to the extent we're about to now spend a bunch of time on March numbers and then April numbers, they're all kind of go out the window when you get to June. So with that, let me hand it over to Martin. We'll go a little faster than usual perhaps on the March numbers because, again, it's what's going on today that actually matters much, much more than what happened in the quarter of March, which was by and large a good quarter.
Right. March was a fantastic quarter, and faster than usual means I'll be done by about noon. So
That was a joke, just in case.
That was a joke. Yes. The Russell 3000, as Larry hinted, was up 11%. Seamus was going to talk about that. It was just a fantastic quarter because risk was on. Non-U.S. equity markets were up 5%. Emerging markets were roughly flat. Obviously now it's part of the news. It's been down.
Are we looking at this?
Yes, I'm sorry. If anyone needs an extra copy, we have extra copies of the quarterly report. Any? Oh, yes. I'm about to go to page 7.
And Martin, just a second. Just want to make sure that the minutes reflect the arrival of our 2 additional trustees. Okay, thank you. Earl, do you need one as well?
So if you turn to page 7, the components, high yield did well. Investment grade credit was roughly flat because interest rates started to move up in that period. But if you turn to page 7, and on the left, you'll see that the returns were very high, very good quarter, 5.23%. And on top of that, we added 70 basis points over the benchmark because of what Larry was talking about, the positioning that we had underweight core plus 5 and tips and overweight U.S. equity. The fund was valued at $46.6 billion. The fiscal year to date at the time, we'll have an updated number in April in a moment, was over 12.25%, also nearly 100 basis points ahead of the benchmark. And the 10-year number was up just shy of 8.75%. If you turn to page 9, this is a page you saw last month, the weights versus the policy on an adjusted basis. You see the green on the left, we're overweight U.S. equity. In the middle, the blue and the light purple, underweight core plus 5 and tips, and the dark purple, overweight high yield. And Larry will talk about that later when he talks about April. Attribution comes up, and it's just like we talked about for the quarter on page 10, 70 basis points. The allocation effect helped because of what I mentioned with the underweight in core plus 5 and the overweight in U.S. equity. And on top of that, the managers did well also. So it was a good quarter all the way around. The 1-year number on page 11, you see the numbers there. Negative allocation effect. Any cash that you owned in an up 10% market hurt. And EFA hurt also as well. Managers, however, did very, very well. Same asset classes as you'll see in the upcoming charts. And 3 years, also a negative allocation effect for cash that we had in the 10% market. And the managers, similar, but the high-yield managers and emerging markets managers also added value. The summary of that is on page 13 and 14. How you did versus other large public funds is on page 15. And for the quarter on the left, the 523, you see it puts you in the 31st percentile. You were just 5 basis points away from being in the top quartile. For the 1-year period, which is the 4th column to the left, your 1046 puts you in the 57th percentile, and you were 4 basis points from being at the median. And you see 3-year and 4-year number. In the 4-year number, you were just shy of the top quartile. And you see the ranges are big, and so this is a fairly good showing. Unless there are any comments on that, I'm going to turn it over to Seema.
Thanks, Martin. If you turn to page 19, this shows, we'll start off with the domestic equity part of the portfolio, about 37% of your total funds. And as you can see here in the trailing 3 months, fiscal year to date, trailing 12 months, nicely ahead of the benchmark for your overall U.S. equities over longer periods are mostly in line with the benchmark, and we'll show some of the detail of the numbers behind this fiscal year-to-date strength. If you turn to the next page. So how you're positioned here in U.S. equities, as you know, about 75% passive, the rest active. What was good in the quarter, and which actually continued through most of the fiscal year-to-date, your active managers have done well across small and large. And what I'd like to point out here is in the column index return, you can see here, as Martin mentioned, the overall U.S. market being up about 11% as measured by the Russell 3000, which is down below in one of the rows. But I wanted to point out, importantly, that you might remember we were overweight small cap, overweight mid cap, and underweight large cap as a policy, and that actually helped us a lot. As you can see here, the small cap Russell 2000 index being up over 12% in the quarter, which has persisted through fiscal year in terms of outperformance, and then the mid cap index up over 13%, and that's again relative to your large cap index up about 11%. So that helped. So if you look at page 27, we'll talk about international. And this page shows your allocation, about 15% of total funds, and just kind of the reverse of in U.S. equities. NYCERS is 75% active in EFA, in developed markets. And so I'll just point you to a couple columns again, the index return, the actual return, and the difference column. As Martin mentioned earlier, the EFA markets were up about 5%. The emerging markets were down a little bit versus the U.S., again, up about 11%. But importantly, what's good to see is on the active side, your emerging markets managers have outperformed their benchmarks for the quarter and for the trailing months as well. EFA active not outperforming as strongly. And you can see on the next page the EFA markets for the trailing 3 months, the purple bar being the total portfolio, the yellow bar being the index, so a bit behind, particularly on the active side, which is the purple bar. You can see that similarly in the fiscal year-to-date and the trailing 12 months. But you might remember we did the new EFA search late last year, and we funded those managers recently. So we've looked at some of the early numbers, and of course it's early, but we expect we should start to see some good outperformance from our new managers over the coming quarters. If you then turn to page 35, we'll look at emerging markets. And as you can see here, about 6% of the total funds. So a couple good things to talk about here. So you see in the trailing 3 months and the quarter, the active managers in particular, the purple bar relative to the yellow bar, which is the custom benchmark, nicely outperforming the benchmark, as well as in the fiscal year-to-date and the trailing 12 months. And again, you might remember that we completed our new emerging market search early last year. We funded those managers kind of early last year, so it's nice to see those numbers. So far, so good. If you turn to the next page, talk about hedge funds. About 3% of total funds today. We're trying to get to 4%, and we're making progress. We have a few to talk about later today. So as you can see in the quarter, a bit behind the secondary benchmark, which is the HFRI fund of funds plus 1%, ahead of the primary one-year T-bill plus 4. But it's good in the fiscal year-to-date and the trailing 12 months. We have some really good outperformance relative to both benchmarks. And we'll talk more about the hedge fund portfolio later today. So now I'll turn it back to Martin unless there are any questions. Okay.
So page 38 shows a pie chart where the assets for fixed income are allocated. It's over $15 billion, nearly a third of the assets. And in green, you see a little bit more than half the assets are in the largest program, the Structured Core Plus 5 program, which on the next page is broken out, and we show the sectors. 17% of the fund, over nearly $8 billion, is invested here. I want to draw your attention, as I have over the past few quarters, to the under-overweight column, which is important given what Larry just said. We've been underweight the Treasury sector. Mortgages is pretty much in line, and overweight the credit sector. Not only did that help in this quarter and quarter before, but that would have helped over the last month or so. And we'll show those numbers obviously when we have them. But overall, for the quarter, of the 15 managers, 13 outperformed. The only managers that underperformed were in the government sector, where the returns were just 1 basis point behind the benchmark. So the allocation was good, and the management effect was good. And taking it together on page 40, you see the returns. While I can't compete with SEMA, the returns on the left side, the returns were just above flatline, but that's still 38 basis points ahead of the index. And for the fiscal year to date, and this is very important, with a very modest 2% return, 2.02% return, the 100-plus basis points the managers added are very important. So the 326 was very good, and similarly for the 1 year, the 593, well ahead of the policy benchmark, and the benchmark is below the actual manager's returns for the entire period. Lastly, I'll draw your attention on the bottom for the 3-year volatility, now well below 3%. That will have ticked up over the last month, and that will be shown in the next quarterly report. But the volatility you see there is abnormally low. The TIPS returns are on page 41. They were slightly negative on an absolute basis, but 21 basis points ahead. PIPCO had a very good quarter. Fiscal year to date and 1 year numbers are positive and modestly positive on an absolute basis, and ahead of the benchmark by about 50 basis points. We have now a 7-year record, actually nearly an 8-year record of over 7%. High yield continued its strong run on page 42. We now have 7 managers, 6 outperformed in the quarter, and as you might expect, with a strong 3.22 return, which is, by the way, over 100 basis points ahead of the benchmark. The manager that underperformed was the most defensive manager, which would have helped over the last month, and we'll confirm those numbers as we get them for June. The fiscal year-to-date numbers were very strong and over 11%, and that was nearly 200 basis points ahead of the benchmark, and the 1-year number at nearly 13%, similarly ahead of the benchmark. I want to point out the 10-year number is well over 9%, and the volatility on the bottom, so the 10-year number, that 9% was on 8% volatility. The 5-year number, the 10%, was on 10% volatility. So it's been slow and steady for the high yield market, and the managers have been adding value on top of that. So it's been a good program so far. Convertible bonds, and we have been overweight, so it's done well. Convertible bonds are on the next page. On the left, you see the numbers higher on an absolute basis in blue. The program 590. It's behind the policy benchmark of 788, but if you see I'm bad at colors, either purple or brown bar, that represents the secondary index, which is the weighted average of the individual managers, and it's right on top of it. As you know, we've taken steps recently to improve the program. The fiscal year-to-date and 1-year numbers are similarly strongly positive because they're correlated to the equity markets behind the benchmark, but we expect that to improve since we made some changes in the not-too-distant past. Opportunistic fixed income is on the next page. As you might expect, strong results on an absolute basis as shown in blue. The yellow is the 10% annual return. There's just a typo there. Fiscal year to date, that should be 741. All the other numbers are 10%. The purple bar is the JP Morgan plus 3% to give you some risk comparison. But this is a program that's still in its startup phase, and we'll have more for the board in coming months about the opportunistic program as a whole. The next 2 pages on page 45 and 46. 45 is our developing manager LM, which, as you see, has done extremely well in all time periods, and 46 is our emerging manager program, fund of funds with progress, which has also done very well for all time periods. And unless there are any questions, I'm going to turn it over to Liz for private equity.
Okay, so I'm actually on page 2 of your bigger booklet, the black binding, the black tape binding. So again, page 10. So this is a quarterly report for your private equity portfolio ending December 31st, 2012. And for the quarter end, NYCERS had a total commitment of $6.7 billion across 142 funds representing 94 relationships. You had total capital contributions of $4.5 billion. The cash coming back to you was $2.3 billion, and a market value of $3.5 billion, giving you a total value of $5.8 billion. In terms of performance, your total value multiple at the quarter end was 1.28 times, and then your IRR since inception for the quarter end was 8.6%. So if you see how that performed against the benchmarks, you could take a quick look at page 11, and then you'll see that, again, NYCERS at 8.6% since inception, underperformed slightly against the Russell 3000 plus 300 basis points, but overperformed significantly against the Thompson 1 median IRR, which came out at 3.8%. So if you turn to page 21, let's take a quick look at the deals that we closed during the quarter end. So during the quarter end, we closed on 3 transactions totaling $183.3 million. It's a Carlisle 6 sidecar co-invest, and then the Platinum Equity Partners. And then subsequent to that, we had 3 more transactions totaling $101 million. If you turn to page 24, just take a quick look at the different strategies you have in your portfolio and how they've been performing for you. And then you'll see that in the table below in the bottom of the page that there are the top 3 performers for you for the quarter were special situations that came in at 18.2 IRR. Again, this is a reflection of the distressed opportunities that are out there. Second to that was secondaries, which came in at 16.9% IRR. Also a function of great deals that are out there now. The pension systems and other financial institutions are restructuring their portfolios. And then followed by large buyouts, which generated 16.4% IRR. So the last point I will bring up is page 28, and that's ending on a very nice high point. That bar chart you see in the middle of the page is really, it's your cash flow activity year to year. So since it's year end, we'll take a look at 2012. You'll see the bottom charts, the darker bars of the capital going out, and the top bar, which is the bars you should really love, is the capital coming back. And you'll see for 2012, you reached an all-time high of $793.8 million coming back to you. Then you'll see the line, the net cash flow representing that is now positive, so your net cash flow positive. This is a function of maturity, and then which even though it doesn't really look like a J curve, it is a J curve. You're coming out of that. So it's a very nice positive trend, and we look forward to seeing more of that as your portfolio continues to mature. And that's it for the quarterly report. And I hand it over to Yvonne.
Okay, great. So let's go over the highlights for the real estate portfolio for NYCERS, and that begins on page 40 of the large board book. As you know, there is a 6% allocation to real assets. As of the fourth quarter 2012, there's about 1.9 to practically $2 billion in the ground in real estate assets at work. There's another $500 million, $500 million in unfunded but committed investments. So altogether, there is an exposure to the real estate asset class of $2.4 billion. In terms of, we are 4.3% funded at this particular point in time. The level of exposure that we have at $2.4 billion, if we look at the portfolio in terms of strategy, consistent with our investment policy, we're at 41% core and 59% non-core. We have about close to 30 managers, 29 managers. We have 42 investments, and all of these are core and non-core. In this particular market environment, you know that we had been focused on non-core opportunities, and those managers have been taking advantage of dislocations that they've seen in the marketplace. On the core side, it's kind of interesting. As markets recovered, investors were going and investing in the gateway cities, New York, DC, and interestingly enough, even though values fell dramatically during the crisis, in those gateway cities, particularly for apartments and office, values have returned above recession values. So that's very interesting. But we do have a good number of managers that are looking for opportunities where dislocations continue to exist. So as we kind of look to the performance specifically for the fourth quarter 2012, we see that the performance of the portfolio was 3% on a net basis after fees. That is an overperformance of 70 basis points over your benchmark. Your benchmark is the Odyssey Index plus 100 basis points. This is a time-weighted index. And below, you see in the graph how your portfolio has performed over its various time periods. So again, we talked about the crisis, and at toward the right of the graph in blue, you see that there are some underperformance by NYCERS, but I think that we've worked very hard to identify managers, both large and small, that have consistently performed over cycles, and that our recent commitments will start to bear its fruit. And as you kind of look toward the left side of the table, you will see that, again, I mentioned the overperformance for the quarter. We're right on top of the benchmark for the 1 year and exceeding the benchmark over the 3 years. In terms of investment activities, post fourth quarter, we closed on 2 investments for an aggregate of $125 million. We still have 3 commitments that we're working to close right now for a total of $175 million. So your managers are working very hard to produce great results. In terms of your net performance on an IRR basis, the net IRR for the program right now is 3.3% at a multiple of 1.1. So that concludes my summary of the performance for the fourth quarter. Ray?
If I may suggest, there's so much data on page 41 and even on page 40, I can barely make it out. Perhaps it might be helpful to simplify this. Maybe we don't need all these points, or maybe it can be oriented as a in a portrait orientation, for insert. It's just getting a headache here reading all these numbers.
We'll definitely work on that. And as you notice, I direct you to those pages. I tried to pull up the salient points, and like core and non-core is addressed in other pages. But as you pointed out, we're going to be working on that presentation.
Thank you.
We'll work on it, Ray.
Thank you.
Point well taken. Anything else? Thank you so much.
Okay, Mark and Tom, you're handing out the Callan performance summary. It starts in your book on page 45, but we're handing out a color copy for you all. Thank you. You can see it better, right? Okay, as you know, we've been doing this exercise for the last 5 quarters or so. We started doing it in September of 2011. Page 2 just outlines where you are on an asset allocation versus your target, your actual versus your target, which Martin went over earlier. Page 3 describes how we devised the interim target benchmark back in 2011. Page 4 starts the portfolio attribution. Similar story to what Martin covered, but for the quarter on page 4 versus your long-term target, you outperformed the benchmark 523 versus 472. The managers in the aggregate added 33 basis points, and the style effect was 19 basis points positive. What helped was an overweight to domestic equity, an underweight to structured fix and tips, and then strong manager performance in domestic equity, structured fix, high yield, and real estate. What hurt for the quarter was the overweight to short term. On page 5, we do the same analysis for the quarter, but against the interim target benchmark. Similar outperformance and similar reasons to what I just described against the long-term target. On page 6 and 7, we're now looking at 1.5 years since we started doing the attribution back in September of 2011. So over this 1.5 year period, you had a total fund return of 16.58 annualized versus a target return of 16.10. The managers in the aggregate added 65 basis points, and the style was allocation was a negative 17 basis points. What helped, again, was the overweight to domestic equity in the strong equity markets over this time period, underweight to structured fix, tips, and the hedge funds, and strong manager performance in domestic equity, structured fix, high yield, international, and real estate. What hurt over this period, again, was the overweight to short term and also to private equity. Private equity return at 7% was a solid return, but the total fund earned 16, so that overweight did hurt. And an underweight to opportunistic fixed, and a weak performance relatively over the 1.5 year period versus the opportunistic fixed income benchmark. On page 7 for the 1.5 years versus the interim target, similar type of performance attribution, outperformed the interim target. Managers added 65 basis points. However, there was a 22 basis points drag in performance from the allocation effect. Again, similar story to what helped and what hurt over the full 1.5 year period. Your peer rankings on page 8 are similar to what Martin showed against the BNY database. However, you see some slight deviations. The 1 year is in the 59th percentile, the 3 year in the 39th, and 4 and 5, 34th and 18th, respectively. On page 9, what we do here in the asset allocation adjusted rankings is we say, well, what if everybody in the database had the same asset allocation as your fund? And this gives us a greater focus on manager performance. And so your rankings improve over all the time periods listed here. So that shows that your managers have been doing a good job versus their peers. All top quartile on this basis over the last 5 years. Page 10 just does the calendar year performance again for the total fund rankings, and then you also have some risk statistics at the bottom of the page on page 10. Page 11 focuses just on domestic equity, and this is the domestic equity in totality with active and passive. As Seema pointed out, the recent performance over the last 2 years has been strong, outperforming the benchmark and ranking in the top third over the last 2 years. Page 12 has the performance on a calendar year basis, and then the risk statistics at the bottom of the page. All the risk adjusted measures are very median with a good chunk in passive. You would expect that versus the peer group. Page 13 is a new page that we have added at the request of the board to show the total active managers, just isolating the active managers. And you see very strong performance over the last year in particular, 16.4% versus the benchmark of 14.56. As Seema pointed out, what helped during the last year really was strong performance from the fundamental index managers and the overweight to small and mid cap. The last 5 years, even though the 2 and the 3 year numbers were more median-like, the 5 year numbers is very strong, 140 basis points above the benchmark and ranking in the top decile against the peer group. Page 14 has a number of the risk statistics for just the total active domestic equity. The tracking error for the active portfolio has been higher than average, however, basically since 2007. However, you have been compensated for that higher tracking error when you look at alpha and information ratio statistics.
And this is all gross of fee, correct?
It is.
So our fees are approximately,
It's in the appendix of the quarterly report.
But it is also compared, the comparisons are also to gross of fee performance for all peers.
Right. But I'm looking at the alpha and the information ratio. So if we're showing an alpha of 29 basis points and our fees are about that, then we do have 0 alpha. So
Well, if we break it down, US and, I'm sorry, active and passive, but the total would be about 20.
how much?
About
20.
20, when you include
20.
that. Yeah.
Okay.
Passive obviously is less than a basis point, and active is obviously more, but the average would be about 20.
Okay. Thanks.
But again, against peers of the same calculation, it's in the 29th percentile. And that's over a 10-year period. So page 15 then looks at the total international equity portfolio. Performance here is not as strong as domestic. The performance over almost all the time periods are below median. That has been reflective of the overweight to emerging markets most recently. That has hurt performance overall. But as you see when we look at the actives, that performance has improved on the active side. Page 16 just looks at the calendar year performance for the total international equity, and then the risk statistics at the bottom of the page, which do rank overall in the 3rd to 4th quartile over long periods of time. Page 17 is the new active international equity pages. You see improved performance over the last quarter and last year. However, the 5 and 10-year numbers are still below medium in the 4th quartile. What helped most recently was strong performance from your EFA manager, Bailey Gifford, and then strong performance from just about all your emerging markets managers, and especially Acadian. The risk statistics for the active international is found on 18. What you see as far as tracking error is consistently low tracking error versus peers, below the peer. However, the risk-adjusted measures are low versus the peer group. Page 19 reflects the total fixed income managers all in one against the long-term target. Performance was ahead of the benchmark for the quarter, basically in line with the benchmark over the last year. Attribution, what helped, overweight to high yield, underweight to tips, and then strong performance from mortgage managers, corporate managers, and opportunistic managers for the quarter anyway. Opportunistic over the year and a half actually detracted value, as we'll see in a minute. And then long-term performance is very good, 5-year number in the 39th percentile, very close to the target, and the 10-year number in the 34th percentile. Page 20 shows the calendar year performance as well as the risk-adjusted measures. The risk-adjusted measures are all very strong, alpha being in the top quartile, information ratio also being in the top quartile. This is over a 10-year period. And then page 21 and forward is the fixed income. Page 21 shows tracking error. And what you see here is up until most recently, you've had lower tracking error versus your peers over time. However, that's come in as of late as the database has lower tracking error. Our tracking error has increased most recently. The risk measures at the bottom of 21 show pretty low standard deviation versus peers, and downside risk numbers are also very low. Tracking error is very low over the last 10 years. And then 22 shows against the interim benchmark. Really not a lot of difference between the long-term fixed income. However, the interim fixed income benchmark has not performed as well. Doesn't have as much in the opportunistic bucket. So your outperformance looks better against the interim over the last year, especially 743 versus 650. but similar reasons for that outperformance: underweight to tips and strong performance from your mortgage, corporate, and opportunistic over the last quarter. And then similar calendar year and risk statistics over time versus the interim benchmark.
Thank you.
Yeah,
Kathy?
that ends the review of the quarter.
I think Kathy,
Kathy's here.
yes.
Oh, I'm sorry to see.
Good morning. We're back into the quarterly report, page 47, where your ETI performance is. As usual, it's shown net of fees, and it has outperformed both its custom benchmark and the Barclays Capital U.S. aggregate for all periods, having done very well in the last year, mostly due to your multifamily PPAR program. So then, turning to page 71 in your large board package, is your collateral benefits report. We did modify the report to the extent that we show now activity for the previous quarter on each page. A couple of highlights through your multifamily public-private apartment rehabilitation program. You did make over $15 million in commitments during the quarter, and you invested $7.5 million in the quarter. And one other highlight I want to bring to your attention is on page 73, that through your investment in the AFL-CIO Housing Investment Trust, a Mitchell-Lama property in Coney Island that was severely damaged by the storm received $89 million in financing from the HIT so that they could quickly make repairs and not wait for the insurance money to come through. It was an $89 million investment. Any questions? Thank you.
Thank you.
Okay, done with the quarter. April, everybody got one of these? Okay, I'm going to try to get you from April to May to yesterday. So let's start on page 34. So we had a good first quarter, as you just heard. Everything worked. And pretty much everything worked in April as well. So again, if you look at the numbers on the far left, the U.S. stock market was up about 1% to 2%. EFA popped up a lot, was up 5%. Emerging markets was up about 1%. Government market was up about 1.5% to 2%. And the high yield market was up about 2%. So not surprisingly, things are up. So if you go to page 30, things are up, and we're set up pretty much the way we've been set up for the last 12 months, except we started to make some changes, I think the month before. We started to reduce our overweight to high yield, and we've taken it down basically 0.3%, 3 to 0.4% a month since March. So March, April, May, and June. So you'll see that number coming down, which has been spot on right. Again, overweight U.S., underweight governments, underweight tips, all seem in retrospect to have been sort of the right things. If you go to page 36, you can see what that added up to. So we're up another 1.5%, the far chart on the left. So the coming out of April, we're up 14%. So far, so good. And if you go to the next page, 35, which is I guess a page before, May was also a pretty good month. So May, if you look again, far left-hand block of numbers, we're up 2 or 3% in the U.S. equity markets. We're down 2 or 3% internationally. We're down 2 or 3% in governments and tips, and we're down about 0.5% in high yield. So I don't have the main numbers for you, but let's assume that when you just run your eyes down this, the biggest number we have is U.S. equities, which was up a couple of points. Let's just assume we're flat in May. So for flat in May, the June numbers go something like this, and this is through yesterday, day before yesterday. So the U.S. market was down 4%, EFA's down 5%, emerging markets down 11%, governments and high yield down 5 to 9%. Okay, so again, back of the envelope gets you some number that smells like down 5 or 6%. But again, we're not done with the month, so we don't have estimates for the month. So again, what would that mean to you? If you go to page 27, what they call the answer. So this is 11 months, this is, I guess it's 12 months, and we have to roll this forward too. So we came into the fiscal year at about $40 billion. In April, we were at about $47 billion. May was about flat, so we're about $47 billion. If you take about 5% off of that, you get to about $44.5 billion, which is, I guess, our estimate is where we're at now. So if we had to put a pin in it, we estimate we're up about 10%. We were up 14. We're now up about 10. And we got 4 days left. It'd be nice to be in double digits. We shall see what we shall see for the rest of the week. But again, we've given some of the gain back. It was nice moving in up 14%. I think we've given back 5-ish%, 4 or 5. So we're plus or minus 10%, and we got 4 business days left. So we'll see. As soon as we figure it out, we'll get back to everybody and let you know how the fiscal year ended. But you know, as we all know, that's the only number that matters. The rest is all interesting, but the only number that matters is June 3rd. So that's April, May, and a hint of June. Again, the markets are bouncing around. The market's up today. Bond market's down today. So we'll just have to see. Okay? Any questions? Perfect. So that ends the agenda for the public session from the Controller's Office.
We have a motion to exit the public session and enter executive session. Thank you. Do we have a second? Do you have a second? All in favor?
Aye.